Hey, welcome back. Stellantis is finally getting back to some very interesting prices, getting close to my initial buying point. Some of you probably remember, but when I bought this, the potential was even as much as a 10x in my opinion, so let's have a look. They had a slow half a year, getting in line with the rest of the market. We see significant drops in revenue, net income and pretty much everything. They even had a negative cash flow, although that's more about the timing of certain payments and investments, and they see it turning positive by the end of the year. But they are developing, launching new models, including cheaper electric ones, plus soon selling Leapmotor in Europe. So for me, the potential remains the same and a couple of bad reports wouldn't change anything. The CEO also reiterated that they are ready to sell the underperforming brands. This is a narrative he had from the beginning, but for now I think it's just an idea. He's currently focusing on fixing the issues in North America, where we can see a significant drop in market share. We don't have a lot of data since the merger is relatively new, but so far in a not excellent environment they made around 10-12 billion per year. They see a lot of synergies as a result of the merger, which can generate quite a lot of value. Of course, a recession or economic downturns means restructuring, cutting costs, firing people, and there is a chance to see them lose money even then. We can see such actions already in response to the recent weak half a year. But there is a very good chance that they might get a boost from the upcoming rate cuts. Now, you can't guarantee much in the market, but car companies being volatile based on the economy is pretty much a given, but more on that in a bit. They target about 20 billion in cash flows by the end of the decade, which would put them at an amazing ratio. For a roughly 40-50 billion market cap, that's basically a ratio of around 2. In other words, if they wanted to pay everything as a dividend, the yield would be around 50%. Obviously, the market wouldn't ignore such a company, opening the potential for a very nice increase. Financially, they are in a good position, with the current assets covering the current liabilities and quite a lot of cash and equivalents. They have 21.5 billion in debt, which they can pay in a couple of years, if they want to. That generates about $1 billion in interest, so they can use a lot of the cash flow to pay dividends or develop, as you are about to see. There is about 82 billion in equity on a 40-something billion market cap. Even after the goodwill, this is still a price-to-book ratio below 1, which is really good for a margin of safety. There are also a lot of provisions in case of lawsuits and other issues, which are pretty normal in the industry, and they are kind of used to that. Still, out of the legacy car companies, this is among the healthiest ones. The pure EV companies are normally new and are in a better shape, but they don't have nearly that many assets, and comparing the market cap to the equity, they aren't even close. Now, the competition aspect is in a very interesting spot. There are a lot of companies, especially from China, that benefited a lot from both the IPO hype and government subsidies. That's how you have companies with 1-2 billion of cash on the balance sheet that barely make money, valued at like 20 billion right now. Another way to look at this is that there is a ton of interest in the market that could eventually move to the companies that prove to be successful. So instead of price to cash flow ratios of 5, maybe 10, we could see the legacy car companies at 12, 15 or maybe more. That by itself could be a 2-3x for Stellantis. Plus, the political factor can be very important. With the current direction we might be going to in the US and Europe, EVs might slow down for a while. But for Stellantis, this is a small branch of the company. Overall, that would actually be great news. They get time to make more money from traditional cars and prepare for EVs, while the pure EV companies would be in trouble. Again, a majority of them don't have the kind of money to survive such an environment. But in this case, I think China might help them even more because they seem to be focused on securing an even higher influence on the whole supply chain, including commodities. Now, I know some people say that maybe they went too slow into the EV market, but imagine if they went all in on that. The market isn't ready to have a full switch to electric vehicles. You need a lot of infrastructure and even regulatory adjustments. Sure, we are getting into that and we can see a majority of oil companies developing that infrastructure, but it's gonna take time. This is why when I talk about lithium or EVs in general, my minimum would be like the end of the decade. Look, I want to stress out that this is first of all a car company. Sure, they have some of the best margins and financials in the market, but they aren't immune to the economy. They already did better than most other companies last year, despite a pretty big strike, when others already had significant issues. Keep in mind that the auto industry is among the worst possible when you have economic issues. However, the time after high rates and economic uncertainty can be very beneficial. There is even a chance that they manage to avoid most of the downside and only feel its effect a bit, and now when rates are gonna be cut, they can enjoy the upside. If the issues continue, there is even a chance to see them temporarily cut or even stop the dividend and buybacks. By the way, the yield is at around 10% now, representing close to 5 billion plus about 2.5 billion in buybacks, so around 15% in total. And the thing is, this is actually very sustainable if they can continue to make 12-15 billion per year. So bad times this is likely horrible, but in good times it can be an amazing investment. Especially since you can have pent-up demand in this industry, the time after a recession or something that would deter the demand can be great. We can see VW, for example, quadrupling in half a decade after the previous recession. Add some 10-15% dividend per year and you can see why this would be at the top of my recession shopping list. As for a valuation, I think the classic 3 scenarios will be enough to get an idea. In a negative one, let's assume they really mess up and lose a ton of market share to the new EV companies. Assuming a cash flow of 5 billion at a ratio of 4, that's a market cap of 20 billion, meaning a price of 6.83 for a more than 50% loss. This can also happen in a recession, but I'm talking about a case where it would be more of a permanent thing, which is very different. But keep in mind that even in this scenario there is a ton of equity and they would still make a good amount of money, making them at least a potential acquisition target. They could even pay a decent dividend if they wanted to, since the current debt isn't such a big issue, so the downside doesn't seem that bad. In a recession, if they get to such a price, this could be a really good buy in my opinion. In a second scenario, let's say they keep doing around the same as a year ago, but we see some more interest thanks to the market developments. So let's say 12 billion, but at a ratio of 7.5. Again, a bit of the money that's currently into the very overvalued EV companies could move into them when they take some of that market share. That's a 90 billion market cap, meaning a price of 30.73, which isn't very far from the recent peak. But that's pretty much a 2x from the current price, plus the potential for a very solid double-digit dividend in normal and good times. So even in this scenario, it would probably be among the top dividend stocks during that time. Now, in a good scenario where we see interest shifting from pure EV companies into the traditional ones as they transition into EVs, let's say they manage to reach the 20 billion target. That's, by the way, a compound annual growth rate of around 8% from last year's level, so it's not really something impossible. Assuming a higher ratio of around 15, that's a market cap of 300 billion, meaning a price of 102.4. That's a 7x increase and it's not even such a high ratio compared to other EV companies. It can be even better, but even this would be amazing. Pay, let's say, half of the cash flows as dividends and that's a yield of around 25% today. So in this scenario, this would probably be one of the best investments this decade. This can be better or worse, and I'm not including the effect of buybacks or dividends, but I think these scenarios should give a pretty good idea. So overall, this is a very good company in my opinion. Financially, it's one of the best legacy auto producers, tons of cash on the balance sheet that can allow them to withstand the recession for ages, and we know they can pay a very nice dividend. There is fundamental volatility, but also potential to see them do very well. Plus, they offer a very nice way to get exposure to EVs because if they are delayed, Stellantis probably does even better, and when they come, they can also benefit from that. Again, they have the financials to keep being a very competitive company even in that market because a majority of the current players are companies with 1-2 billion in cash that benefited a lot from Chinese subsidies. They warmed up the market and tested the waters, and now companies like Toyota, Stellantis, Ford, VW and so on can adjust and also come with very powerful brands to back them up. On top of that, the regulatory field is also adapting, and judging by the political direction across the globe, Stellantis might see a relatively friendly environment. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching and I'll see you next time.